Today we're going to break down the retirement investing lies that I see too many retirees fall for. As the owner of an independent financial planning firm, my company and I help clients every week manage the stress of investing through easy-to-follow portfolio education. Every week I speak to clients who are burdened by the stress of managing their retirement portfolio. From investing in the right areas to understanding when they should extract income, most retirees struggle to understand if they are doing enough. Well, today, not only are we going to reveal 4 myths of retirement investing that all retirees believe, but we will also run through what you can do about them. And I think this is one of the most fascinating videos I've made to date. The research for this video was particularly interesting. So fair warning, this video is going to be particularly chart heavy. Now, the first investing myth is that ETFs and mutual funds are superior to directly held stocks or bond investments. I'm going to show a few charts that demonstrate this in just a moment, but I'm going to begin with a conceptual explanation. The case for exchange-traded funds and mutual funds are that they delegate the portfolio construction to more experienced parties. In the case of the fund, it's the fund manager. And the case continues that these funds offer additional diversification by making a basket of investments available to an investor so that they do not end up overly concentrated in one investment. And while those things are true, there are trade-offs that an investor has to make in order to invest in an exchange-traded fund or mutual fund. For instance, when you invest in stocks through a fund, and certain sectors of the economy or certain companies themselves go through a period of price declines, you cannot sell a part of your fund in order to reorganize your portfolio and limit the damage. You simply have to hold that fund and wait for it to recover as a whole, which means that you have given up influence over your portfolio's outcome. Now, owning single stocks outright allows you to trim underperforming parts of your portfolio and still achieve protection via diversification, so long as you combine single stock ownership with monitoring the right risk measures. So let's take a look at this concept in action using data from Portfolio Visualizer, a free online portfolio backtesting tool. We're going to compare two 60% stock and 40% bond portfolios. Both have nearly identical asset allocations. Portfolio 1 is a globally diversified portfolio composed of only Vanguard mutual funds. And Portfolio 2 is a globally diversified portfolio but holds 24 individual stocks, as well as a range of index funds and mutual funds that make up the difference. Both portfolios were back-tested from January 2013 through August 2024. I'm going to pull up the summary tables here that were the export of the data from Portfolio Visualizer. This first summary table compares the funds-only portfolio, the one with only mutual funds, to the portfolio with 24 directly held stocks across 3 specific measures. The first measure is annualized rate of return. The second measure is standard deviation or variance, which is a measure of volatility. The higher the variance, the bigger the fluctuation in the price or value of the portfolio, both to the upside and the downside. And then maximum drawdown. And drawdown tells us what the largest percentage decline in the portfolio would have been across this 11-year testing period. Now, as you can see from the summary table that I pulled up on the screen here, the portfolio with the directly held investments would have had nearly double the rate of return, but only if you could stomach double the maximum drawdown over that same period and not panic sell or exit the portfolio. And so in the scenario I'm showing right here, actually the funds only portfolio would be the clear winner in my opinion, because the reduction in volatility would be worth the sacrifice in terms of rate of return. And we'd rather have a portfolio that you can stick to than one that's so volatile that you make panic moves, even though we're sacrificing rate of return. But what if we apply a trimming mechanism to those two portfolios, and that trimming mechanism reduces some of the volatility in the directly held stock portfolio? We can run the same back test and apply a quarterly rebalance to each portfolio. And effectively what that quarterly rebalance does is it acts as a trimming mechanism that makes it so that individual stock positions within that directly held portfolio don't run away and become so large that eventually when there's a correction in the market, we have disproportionate size corrections on those individual stocks. And we now arrive at this second scenario down here, a second summary table. And you can see from the results in this summary table, with the trimming mechanism in place, the directly held portfolio does have significant reductions in its rate of return, but it also sees more than a 2x decrease in the actual volatility measures. So we can go through these really quickly. The directly held portfolio came down from a 20.2% rate of return to a 10.8% rate of return. More importantly, the variance or standard deviation came down from 20% to 9.8%, and the maximum drawdown came down from 42.3% to 20.1%. And in actuality, when we look at these portfolios side by side, the one with the individual stock and the one with the funds only, the actual individual stock portfolio that has a combination of stock and funds has the same risk measures as the funds only portfolio, but outperforms by almost 3%. And this is really interesting because these two portfolios have the exact same asset allocation, but simply by adding in some directly held, very, very small stock positions and having a trimming mechanism in place to reduce losing positions results in this almost 3% increase in rate of return over 11 years with nearly identical risk profiles. Now, unfortunately, in this video, I'm only going to have time to briefly cover 3 more retirement investing myths and how they impact your retirement plans, but I'm going to be releasing a video in the next couple weeks that's going to break down how you can get ahead of these issues by creating a 5-year retirement plan. So if you want to catch that video, make sure to subscribe to the channel now. And we're going to move on to the second investing myth now, which is that active investment strategies are inferior and less reliable than passive or buy and hold investment strategies. And the root of this myth is in how it's framed. The active versus passive management argument is usually centered around the fact that actively managed portfolios do not reliably beat the market, and therefore passive investing is superior. Well, I would make the case that the argument is better framed such that active management is not about achieving a superior rate of return, nor is it about timing the market, but it's actually about, can an actively managed portfolio produce the same rate of return, but do so with less risk? Now, let me illustrate this using the same 60-40 portfolios from the prior scenario, and let's apply an active investment management approach to the portfolios, something called tolerance band rebalancing. Tolerance band rebalancing is a portfolio management rule that instructs an investor to perform a set of trades, or rebalance, when a target threshold is reached. That target threshold is applied to each individual investment within the portfolio. So for example, if we had a tolerance band of 2% placed upon the portfolio, that would instruct the investor to rebalance any position in the portfolio when it moves either up or down by 2%. So say you have a 10% position of VTIAX, a Vanguard International Equity Mutual Fund, in your portfolio. A 2% tolerance band would instruct you to rebalance that position back to your original 10% weighting whenever VTIAX hits either 8%, meaning a 2% reduction in value or size, or 12%, meaning a 2% increase in size. Now, when we go back to Portfolio Visualizer and apply that 2% absolute tolerance band, we end up with this new summary table, which I'm going to pull up on the screen here. And we're going to show results from that same testing time period, January 1, 2013 through present, which is August 2024. And the results, once again, are fascinating. Now, in the funds only portfolio, the rate of return goes down from 9.2% to 7.9%. The variance goes down from 11.5% to 9.7%. And the maximum drawdown goes down 23% to 21%. So those are modest sacrifices to reduce volatility, but also reduce rate of return if you applied the rebalancing to the funds only portfolio. But basically what we're doing is giving up a bit of growth for a very minor risk reduction. Where this is really eye-opening though is when we combine the active management with a portfolio that has directly held stocks plus funds in the portfolio, which is the right side of these summary tables here. And that portfolio sees a dramatic decrease in the rate of return from 20.2% to 11.2%. But we also see the variance or standard deviation go from 20% to 10.1, so almost half. And from the drawdown goes down from 42.3% to 20.7. So again, more than half of a reduction in the risk. And so effectively what's happening with this directly held portfolio, when we combine active management, this ends up with a roughly 3% greater rate of return for roughly the same risk profile as the funds only portfolio. Now, to put a capper on myth number 2 here, let's take a look at this final summary table pulled from Portfolio Visualizer. You can see here that in the same testing scenario where if both investment portfolios had started with a $1 million starting balance, the funds only portfolio would have an ending balance at the end of that 11-year period of $2.428 million, where the directly held portfolio ends with about $1 million more. The cumulative return, while excellent in the funds only portfolio, is 143% roughly. In the directly held portfolio, you get 100% greater cumulative return, totaling for a 244% cumulative return. Now, more interesting to me are the best year right here, which is that with the funds only portfolio, you get a 20.82% best year, With the single stock addition to that portfolio, you have a 24.4% best year, meaning a almost 4% increase. Remember, you're also seeing a reduction in volatility to the downside here. You actually have a single stock portfolio that has less or smaller total maximum drawdown, meaning the worst period in that portfolio's 11-year history was actually less bad when you held single stock in the portfolio than when you held a portfolio comprised of only funds. And then on top of that, both portfolios actually had the same worst period, meaning their worst performance was from January 1st, 2022 through September 2022. They shared the same worst year, but the portfolio with the single stock actually had less downside risk in it. So, okay, now we're going to move on to the third investing myth, which is that bonds are always the safe part of the portfolio and stocks are always the risky part of the portfolio. So did you know that many of the total bond funds that you might invest in commonly, like VBTLX, which is a very common Vanguard bond fund, actually holds corporate bonds, mortgage-backed securities, and sometimes even junk bonds? VBTLX, the Vanguard Bond Fund, which I've now pulled up on the screen here, actually has 20% of its funds in mortgage-backed securities. It has another 25% of its funds in corporate bonds split between industrial and finance. And then it has around 2% of its funds in mortgage-backed securities, commercial mortgage-backed securities. Now, not only that, but nearly 26% of VBTLX holdings is actually in A and BBB rated investments, which are the third and fourth tier of credit quality. 13.2% of VBTLX's holdings are actually in BBB credit quality bonds. And these are all investments that might be considered risky. So the question is, why are they included on the safety side of an asset allocation? I'm going to illustrate this point further by showing you a price chart of a very common US Treasury bond fund, TLT. TLT is the 20-plus year US government bond fund. Since the start of 2022, that fund, which again is considered a safe asset, it goes on the bond side of your portfolio, was down nearly 41% at its lowest point. You can see that here in this price chart from Portfolio Visualizer. Now, that 41% decline was nearly double the maximum loss experienced by VOO, which is the S&P 500 index fund. That one had a maximum loss of about 22% over that same time period. Let me show you an example now from the opposite side of the asset allocation fence, the stock side. So how do we deal with value companies like Pepsi or Kroger? I've now brought up another backtesting scenario where from January 1, 2022 through December 31, 2023, while TLT, which was supposed to be a safe asset, was decreasing in value by 31% over that time, Pepsi was up 6.77%, Kroger was up 0.44%, and Meta was down 64.22%. Now the question is, how do we square the fact that Kroger and Pepsi are placed on the same side of the asset allocation fence as Meta, while TLT is placed on the safety side of the fence? So from this backtesting scenario, it would look a lot more likely that TLT and Meta should belong on the risk side of the asset allocation fence, while Kroger and Pepsi hang out on the safe side of the asset allocation fence. Part of the reason for what we see in this specific scenario is that Meta and TLT are what would be considered interest rate sensitive investments. So bonds with longer durations, meaning longer contractual lifespans, or lower credit quality are higher on the interest rate sensitivity spectrum. And then certain types of growth stocks and smaller market cap companies like small caps and mid cap companies are also high on the interest rate sensitivity spectrum. What that means is that when interest rates go down, the prices of those stocks go up. But when interest rates go up, the price of those stocks go down. They have an inverse relationship to interest rates. And for this reason, I believe a much better risk versus safety allocation metric would be interest rate sensitivity rather than the conventional wisdom that uses broad general categories like bonds and stocks and places them against each other. All right, now let's get to the fourth and final investing myth. And that's the investing myth that global diversification has actually provided a diversification benefit. So for the past 22 years, the global stocks have moved largely in lockstep with the USA. If we look at this chart I brought up on the screen here, you can see that VGTSX, which is a Vanguard Developed Markets ex-US, meaning there's no US investments in it, it's a fund that tracks only developed markets, is the dark blue line. The light green line, VEIEX, is the Vanguard Emerging Markets Fund, again, ex-US, doesn't have any US stocks in it. And then the gray line is VTSAX, which is the US total stock market. And what you can see here, the takeaway from this chart, is that pretty much all the market downturns happened at the same time. You can see right here, there was a market downturn in all three types, ex-US, emerging markets and US all face it at the same time. Same here, same here, same here, same here, right? And I could just repeat this. So effectively, what this means is that being outside the US did not actually provide any hedging against US stock positions. If they did provide hedging, we would see an inverse movement. When the US funds were down, the ex-US or the outside the US funds would have been up, but we don't see that. If we bring up a summary table for those three positions over that 22-year time period, we see that it actually just made more sense to invest within the US market. VTSAX, the US total stock market fund, won across all three metrics. It had a better rate of return and lower volatility and risk measures compared to both ex-US and developing markets. It had the highest rate of return for the lowest trade-off in terms of risk. So I'm going to wind the video down here. This has been an extremely fascinating video to make. It really illustrates so many of the inconsistencies within the conventional retirement investing narrative. And while past performance does not predict future results, it's quite eye-opening to see that many of the investing recommendations retirees receive have simply not panned out to provide the results that were expected, from portfolio construction to diversification, to risk management, and even to asset allocations. I definitely plan to dive into each of these subjects in this video in more detail in the future and flesh the concepts out further. But if this piques your interest and you'd like to learn more about how we at Peak Financial Planning help our clients construct robust, risk-managed retirement portfolios and retirement plans, you can visit our website at www.thepeakfp.com. As always, thank you for your time and attention, and I'll see you in the next video.